Welcome back to the deep dive. Today we're not just looking at a company, we're looking at an event, a financial crater, really, that just appeared on the landscape of the tech world last Thursday.
Yeah, crater's a good word for it.
We're stepping into the world of Griffonomics.
Griffonomics.
Mhm.
It sounds like some kind of made-up academic discipline, but in this case, it's actually a very, very serious look at capital allocation.
It does sound official. But seriously, we are taking a massive step back today to look at Amazon. And, specifically one number that dropped on Thursday, February 5th, 2026.
Mm-hmm.
A number that I think it's fair to say effectively broke the mental models of about half the analysts on Wall Street.
Oh, it didn't just break models, it completely broke the narrative. I mean, for the last year, the whole story has been about efficiency, right?
Cutting costs, doing more with less.
Exactly. And then Amazon just drops this bomb.
The number is $200 billion.
$200 billion in a single year.
I just want to pause on that because billion is a word we throw around so much in tech, we get numb to it.
We do.
But just to give everyone listening some context, the entire Apollo program, landing a human being on the moon, cost about $250 billion in today's money. Amazon is spending nearly an entire Apollo program in just 2026.
That's right. And Apollo took a decade of, a full national effort. Amazon is trying to deploy this capital in 12 months. That's the scale we're talking about here. It's industrial warfare.
So the company is Amazon. The context is their Q4 earnings call. And the reaction was, well, panic feels like the right word, doesn't it?
Panic is fair. The stock dropped, 12% in pre-market trading right after the news broke. You have to understand the psychology of an investor here.
Mm-hmm.
Usually when a CFO announces capital expenditure, investors just kind of nod politely. They expect a number that's, in line with revenue growth. This time, there was an audible gasp on the call.
It was a total hold my beer moment.
It really was. Just the day before, you had Alphabet Google come out and say, hey, we're spending somewhere between 175 and 185 billion. And the market thought that was aggressive.
That was already seen as pushing it.
Oh, yeah, that was pushing the absolute limit of what people thought was sustainable. And then Amazon just walks in the next day, looks at Google's number and says, that's cute. Watch this.
But why? I mean, that is the mission for this deep dive. We really need to figure out if Andy Jassy has lost his mind and is just burning cash in a bonfire, or if they are seeing something about the future of AI that the rest of us are missing.
That is the central question. Is this a company losing its discipline, succumbing to FOMO, fear of missing out?
Right.
Or are we looking at a company that sees the future so clearly that they are betting the entire farm, the retail farm, the logistics farm, everything on securing their dominance for the next decade?
We're calling this the all-in AI pivot. And to really get it, we have to look at the roadmap. So we're going to break down the business segments, especially AWS, which is the crown jewel here.
It has to be the starting point.
Yeah. Then we're going to unpack this concept of agentic AI, which is apparently why they need all these chips in the first place.
The why behind the spend.
We'll look at silicon sovereignty, their whole custom chip strategy. And then we have to talk about the scary part, the financial risks.
The negative free cash flow. That's the line item keeping portfolio managers up at night.
Oh, Wall Street hates those words. But let's start with the engine itself. Before we get to the $200 billion spending spree, we have to understand where all this money is coming from, because Amazon isn't just a tech company, and it's not just a store, it's this beast with 3 heads.
It's a cash-generating machine that just feeds itself. You really have to look at the business model as a series of subsidies. But let's start with the main profit engine. The reason Amazon exists as we know it today is Amazon Web Services, AWS.
The cloud, the plumbing of the internet.
Exactly. And if you look at the numbers from Q4 2025, they are just staggering. AWS alone has hit an annualized revenue run rate of $142 billion.
$142 billion. Just from the cloud business. I mean, that's bigger than the GDP of entire mid-sized nations. It's bigger than Intel. It's bigger than IBM.
It is. And what's absolutely critical here is the acceleration. For a while, back in 2020, 2024, people were getting worried that AWS was slowing down as companies optimized their spend.
That was the whole narrative, cloud optimization.
It was. But then in Q4 2025, revenue grew 24% year over year. That is the fastest growth rate they've seen in 13 quarters. So this isn't some dying legacy business. This is a re-accelerating monster.
And it's profitable, right? This isn't just empty growth.
Oh, highly profitable. Operating income for AWS hit $12.5 billion in just that one quarter.
In one quarter.
In a single quarter. That's up 17% year over year. So when we talk about Amazon spending money, you have to remember that AWS is generating a massive chunk of that cash internally. It is just a fountain of liquidity.
But AWS isn't the only thing paying the bills, and this is where Amazon is so different from, say, Microsoft or Google.
It's a key distinction.
Microsoft doesn't have a logistics network delivering toothpaste to your door. Google doesn't own warehouses. Amazon does. And for a long time, people thought the retail side was just this low-margin drag. Why are they selling socks? It brings down the overall margin. But that's changing, isn't it?
Drastically. This is what we're calling the subsidy engine. You have the retail and logistics side, which generated an incredible $25 billion in operating income in Q4. Management is now explicitly using the cash flow from e-commerce to subsidize this massive AI infrastructure build-out.
So, wait. Every time I buy a blender or a book, I am technically funding a data center somewhere in Virginia.
Effectively, yes.
Yeah.
They're taking the money from the boring business, the physical goods business, and just pouring it directly into the future business. But to make that work, the boring business has to be incredibly efficient. And this is where the story gets a little ruthless.
I read something in the notes about an efficiency drive. Ruthless was the exact word that came to my mind, too.
It is ruthless, but from a shareholder perspective, it's brutally effective. They have a stated goal to automate 75% of their operations by 2027.
75%? 3/4 of the entire operation?
Yes. That covers fulfillment centers, sorting, even last-mile logistics planning. We are talking about a massive shift toward robotics machines, like the Sparrow arm that can pick individual items, and Proteus, which moves autonomous carts around the warehouses.
And what does that mean for the humans? Because you can't automate 75% of the work and keep 100% of the staff. That math doesn't work.
No, you can't. And we're seeing the human cost of that strategy play out. They recently cut 16,000 corporate jobs, and that was on top of 14,000 prior cuts. They are stripping costs out of the retail side to make it a lean, mean, cash-generating machine.
Wow.
They're effectively telling the entire retail arm, your only job is to generate cash for the AI war. Do more with less.
So more robots in the warehouse, fewer humans in the office, all to pay for the cloud. It's a very, very clear transfer of resources. But there's one more piece of this puzzle, right? The quiet cash cow that nobody really talks about.
Advertising.
I feel like people still forget that Amazon is an ad giant. You know, we think of Google and Meta.
They do, because it's kind of hidden in the background. It's the sponsored products you see when you search for shampoo. But Amazon's advertising business is now generating $69 billion annually.
$69 billion. That's larger than YouTube's ad business.
It is massive. And you have to remember the margins on ads are incredibly high. Unlike selling a television where you have to buy the TV, ship the TV, handle returns.
Right.
Selling an ad is just selling pixels. It's almost pure profit. So you have this three-headed beast. AWS is printing money, retail is becoming hyper-efficient through automation, and ads is this quiet, high-margin cash machine. That is the war chest they are using to fund this $200 billion bet.
Okay, so they have the money, or at least they have the cash flow coming in. But let's talk about the spending itself. Because $200 billion is, it's a number that requires a serious justification. Wall Street was expecting, what, maybe $150 billion?
Right. The consensus among the big banks was somewhere around $150 billion, which, by the way, would still have been a record.
Still huge.
Still the biggest ever. So coming in at $200 billion was a $50 billion surprise. That's why the stock dropped so hard. Investors saw that extra $50 billion and immediately thought, diseconomies of scale.
Diseconomies of scale, meaning they're just getting too big and sloppy, wasting money.
Exactly. The fear is that Amazon is just bloating. That they're panic spending just to keep up with Microsoft without a clear plan for return on that investment. It brings back these very scary memories of the dot-com bubble, where companies burned cash building fiber optic networks that literally nobody used for 10 years.
But the CEO, Andy Jassy, he says that's not what's happening. He came out swinging on the earnings call. He's arguing this isn't a field of dreams situation. It's not, if you build it, they will come.
No. His defense is fascinating, and if he's right, it changes the entire thesis. He's arguing that this is a supply crisis, not a demand crisis. He says the demand for AI services is, and I'm quoting here, insatiable.
Insatiable.
And that it currently exceeds their ability to supply it. And he didn't just say it, he brought the receipts.
The backlog.
The backlog.
Yeah.
The AWS backlog surged 40% year over year to $244 billion.
Okay, let's just pause on that number for a second. $244 billion. That's $250 billion.
And that is the remaining performance obligation. It means customers, big enterprises, governments, startups have already signed contracts committing to pay Amazon that money. It's not a hypothetical. It's not a sales projection. It is contractually committed future revenue.
But Amazon can't cash the check yet. They can't book that revenue.
Correct. They can't recognize that revenue until they actually provide the compute service. And to provide the service, they need the chips, they need the data centers, they need the cooling systems.
So effectively, Jassy is saying there is a line of people outside our store waving money at us, and we physically cannot let them in fast enough because the store is too small.
That is the perfect analogy. He actually used the phrase, "We are monetizing capacity as fast as we can install it."
Wow.
Every time they plug in a new server rack, it starts making money immediately. That is a very, very different dynamic than the dot-com bubble. In 2000, they built the road hoping cars would eventually appear. In 2026, the traffic jam is already here, and Amazon is just frantically trying to pave more lanes.
Okay, so the traffic is there, the demand is real. But why? What kind of cars are these? We've had chatbots for a couple of years now. Why does 2026 suddenly require a $200 billion upgrade? This brings us to what you call the Agentic era.
This is the strategic inflection point. This is the technical leap that explains the massive cost. Up until now, we've mostly been dealing with generative AI in the form of chatbots.
Right. I type a prompt, it gives me text. I ask for a picture, it gives me a picture. It's cool, but it's still kind of a passive tool.
Exactly. It's like a really smart encyclopedia or a very fast intern who can draft an email for you. But 2026 is the year we shift to agentic AI. And we need to define what that means because it sounds like buzzword soup, I know.
It does.
An agent isn't just something that talks to you. An agent is software that does things. It performs tasks autonomously in the world.
Okay, give me a concrete example.
Yeah.
How is an agent different from me using ChatGPT?
Okay, let's take booking a corporate trip. With a chatbot, you might ask, what are the flights from New York to London next Tuesday? And it gives you a list. You still have to go to the airline website, book it, put it in your calendar, email your boss, file the expense.
Right. It's a research assistant. I'm still doing all the legwork.
An agent is different. You give the agent a goal. Book me a round-trip ticket to London for the conference next week. Keep it under $2,000, use the company card, and make sure it doesn't conflict with my daughter's recital on Friday.
So it's more of a delegation.
Exactly. The agent then goes out, it searches flights, it checks your calendar for conflicts, it logs into the airline site using your credentials, books the ticket, adds the confirmation to your calendar, and automatically files the initial expense report. It takes action.
So it's like hiring a human assistant rather than just using a search engine.
Precisely. But here is the compute problem. And this is why Amazon is spending $200 billion. A simple chatbot interaction is a sprint. It takes a few seconds of compute time. An agent interaction is a marathon.
Okay, unpack that for me. Why does the marathon cost so much more?
It all comes down to inference time. When you use a chatbot, the GPU fires up, predicts the next words in the sentence, and then it shuts down. It's a quick burst. Done. But an agent enters what the engineers call a perception action loop. It's constantly working.
The loop.
A loop. It perceives the data, like flight prices. Then it thinks, using a process called chain of thought, to evaluate if a flight fits your schedule and budget. But maybe it hits a snag. The preferred flight is sold out.
Right.
It have to rethink. It generates a new plan. It tries a different airline. It verifies the credit card has a high enough balance. This single request from you might keep a GPU running at 100% utilization for minutes, or in complex cases, even hours, as it works through the problem and its subtasks.
I see. So we are moving from a world where I rent a GPU for maybe 5 seconds to answer one question
to a world where you are effectively hiring a digital employee that occupies that GPU for an entire work session.
And if millions of businesses suddenly hire millions of these digital employees to do things,
then the current global supply of GPUs covers maybe 1% of the potential demand. That is the insatiable demand Jassy is talking about. He's not building servers for chatbots anymore. He's building the digital office space for this new digital workforce.
that makes so much sense. The compute density per user, per task, is just exploding. And they even launched something called the Ads Model Context Protocol, which sounds incredibly boring, but I bet it's related to this.
It sounds boring, but it's incredibly lucrative. It basically lets AI agents manage ad campaigns autonomously. So instead of a human marketing manager tweaking bids on Google keywords all day,
Right.
an AI agent watches the market 24/7 and adjusts millions of bids in real time to maximize return. That requires a massive continuous amount of compute power. It's always on, always thinking.
Okay, so that explains the why. The software is getting hungrier and smarter, and they need to build a much bigger factory to feed it. But let's talk about the how much, because this spending is creating a very real financial conflict. We mentioned earlier that Wall Street hates negative free cash flow.
They despise it. Free cash flow, FCF, it's the holy grail for mature companies. It's the cash left over after you pay for all your operations and your capital expenditures. It's the money you can use for dividends, for share buybacks, for paying down debt. It's the sign of a healthy, disciplined company.
And Amazon is about to go into the red on that metric.
Deep into the red, most likely. The analyst consensus is that Amazon's free cash flow will turn negative in 2026. And this is a shock because Amazon has been a cash flow machine for years. And this is where the comparison to Google gets really painful for Amazon shareholders.
How so?
Google is spending nearly as much, let's say $185 billion. But Google is so insanely profitable, thanks to their search monopoly, that they will likely remain cash flow positive even while spending all that money.
So Google gets to pay for its new toys with cash from its wallet. Amazon has to, well, break into the piggy bank.
They have a lot of cash on hand, so they're not in trouble, but they might have to tap the debt markets. And more importantly for investors, it means share buybacks are probably off the table for a while.
And explain why that matters so much to the market.
Well, when a company buys back its own stock, it reduces the number of shares out there, which mechanically drives the price of the remaining shares up. Investors love it. It's artificial support for the stock price. If Amazon stops the buybacks because they have no free cash, the stock could become dead money for a year or two.
Dead money. That is not a phrase you want to hear if you're holding Amazon stock in your 401k.
It's the big risk. You are asking investors to endure a year, maybe two, of zero returns or even losses in exchange for the promise of total dominance 3 years from now. It requires a lot of faith.
There's also this other debate, the growth cap. And I want to play devil's advocate here for a second. You're painting this picture of an unstoppable juggernaut. But if I just look at the growth percentages, Amazon kind of looks tired. AWS grew 24%. Impressive, sure. But Google Cloud grew 48%. Microsoft Azure is up near 40%. If I'm a momentum investor, aren't I just betting on the faster horse? Why would I stick with the slow one?
This is the trap. This is where looking at percentages alone can really lie to you. You have to look at the absolute mass of the object that's moving. It's the classic law of large numbers.
Okay, I love a good law. Walk me through the math on this.
Okay, imagine you have a little lemonade stand that makes $100 a year. If you grow by 50%, you've made an extra $50. Great job. Now imagine I have a lemonade conglomerate that makes $10,000 a year. If I only grow by 10%, I've made an extra $1,000.
Right. Your 10% growth added way more actual cash to the pile than my 50% growth.
Exactly. So let's apply that. Google Cloud is running at about a $60 billion annualized revenue rate. So that amazing 48% growth means they added roughly $29 billion in new revenue over the year. Huge. An incredible result.
Okay, so Google added $29 billion in new business.
Now look at AWS. Their base isn't $60 billion, it's $142 billion. They're more than double the size of Google Cloud. So when they grow only 24%, they're adding nearly $34 billion in new revenue.
Wait a minute. So even though Google is growing twice as fast in percentage terms,
Amazon is still adding more actual dollars to the pile every single year. The gap between them isn't closing in absolute dollar terms. It's actually still widening.
it's like a cruise ship racing a speedboat. The speedboat looks a lot faster, but the cruise ship just displaced more water than the speedboat even weighs.
That's a perfect way to put it. And that scale matters because of what we talked about earlier, cash. That $142 billion base isn't just revenue. It's high-margin cash that helps fund the $200 billion build-out. Google has to take money from its search business to fund its cloud business. Amazon's cloud largely funds itself.
So they're still the 800-pound gorilla in the room, even if the chimp next door is jumping up and down a little faster.
Correct. But that chimp is getting bigger. And that is why Amazon feels the pressure to spend that $200 billion. They cannot afford to let that gap close any further. And a huge part of keeping that lead is making sure they aren't dependent on anyone else. Which brings us right to the Nvidia problem.
The Nvidia problem. It seems like everyone in tech has it. Everyone is addicted to Nvidia GPUs.
They are.
They're the gold standard for AI, but they are incredibly expensive and they are incredibly hard to get.
And if you're Amazon, you absolutely loathe being dependent on a single supplier for anything. It goes against their entire corporate philosophy.
Yeah.
You want to control your own destiny. And this is where their strategy of silicon sovereignty comes into play.
Silicon sovereignty. It sounds like a title for a spy movie, but it's arguably the most important part of this entire deep dive.
It is. I mean, Amazon has been quietly building a custom chip business that is now, on its own, generating over $10 billion in annual revenue.
Hold on, their chip business alone is a $10 billion company.
Yes. If you were to spin out their internal chip division, it would be a Fortune 500 company by itself. They have two main lines: Graviton, which are their CPUs for general computing, and Trainium, which are their specialized chips for AI.
And Trainium is their answer to Nvidia.
It's the direct challenger. They just launched their second generation, Trainium 2. And the claim from Amazon is that it offers 30–40% better price performance than comparable GPUs from Nvidia.
Price performance. That's the key phrase for Amazon always, isn't it? They aren't trying to build a chip that's necessarily faster than Nvidia's best. They are trying to build one that's cheaper for the same amount of work.
Exactly. Amazon's entire brand is built on low cost, high volume. But there is a much deeper layer here. It's all about margin capture.
Okay, explain that. What do you mean by margin capture?
Okay, let's say Microsoft or Google goes to buy an H100 chip from Nvidia. They pay, let's say, $30,000 for it. Nvidia keeps a huge chunk of that, maybe 80%, as gross profit. That is profit that is leaving Microsoft's building and going straight into Jensen Huang's pocket at Nvidia.
Right. Microsoft is effectively just a reseller at that point. They are paying the Nvidia tax.
But Amazon designed their own chip, Trainium. They pay a manufacturer like TSMC to physically make it, probably for just a few $1,000s. They don't pay that massive markup to a middleman. They get to keep that margin for themselves.
So their fundamental cost basis for delivering AI compute is just structurally lower than Microsoft's or Google's.
Drastically lower. And here is the kicker, the classic Amazon move. They pass some of that savings on to the customer. They can go to a startup and say, hey, run your AI model on our Trainium chips, and your cloud bill will drop by 40%.
And that's an offer that's hard to refuse.
It's almost impossible. But here's the genius part. Even at that lower price, Amazon still makes a higher margin on that sale than they would if they were just reselling Nvidia chips.
That is diabolical in a business sense.
It's classic Amazon. It's Jeff Bezos' old saying, your margin is my opportunity. They are treating compute power like they treated shipping boxes. Commoditize it, drive the cost down, and make it absolutely impossible for anyone else to compete with you on price.
But does it actually work? I mean, is the chip any good? Or is it like the Amazon Basics version of a GPU where it kind of breaks after a week?
That was the big fear for a long time. For years, developers would say, the software stack around Trainium isn't there yet. I'll just stick with Nvidia's CEDA platform. It was a real hurdle. But then Amazon dropped Project Rainier.
Project Rainier, tell me about that.
This is a huge, huge strategic move.
Yeah.
Amazon invested billions of dollars into Anthropic, the company that makes the Claude family of AI models, a direct competitor to OpenAI.
Right.
As a core part of that partnership, Amazon is deploying 500,000 of its own Trainium chips, specifically for Anthropic to use.
500,000 chips just for one customer. That's an insane number.
It is, and it matters for two critical reasons. First, it locks Anthropic, a major cutting-edge AI player, into Amazon's hardware ecosystem. Anthropic has to use Amazon chips to train its next-generation models.
So it guarantees a huge anchor tenant.
A huge one. And second, it validates the hardware for everyone else. If Trainium is good enough to train Claude, one of the world's smartest and most advanced AI models, then it's probably good enough for Bank of America or Netflix or any other enterprise.
It's a massive stamp of approval, and it breaks the Nvidia monopoly, at least inside their own walls.
It effectively builds a wall around their garden. If you want the absolute best price on AI compute, you come to AWS and you use Trainium. That is a deep, deep moat. And once you build all your software on the Trainium stack, it is very hard and expensive to leave. You are locked in.
Speaking of moats and things that are incredibly expensive, let's look up at the sky for a minute, because Amazon isn't just digging into the ground to build data centers. They are launching thousands of satellites. Project Kuiper.
Project Kuiper. This is the other big bet. And honestly, it's the one that confuses investors the most.
Yeah, I can see why. I mean, Elon Musk has Starlink. It's already up there. It works. It has millions of users. Why is Amazon spending billions and billions of dollars to catch up in a race that looks like it's already been won? Are they just jealous?
I don't think it's jealousy. I think it's about owning the edge. Amazon is planning over 20 satellite launches in 2026 alone. Now, you're right. Currently, this project is a cost drain, about a $1 billion headwind to their earnings. But the strategy isn't just to sell you internet service for your RV.
What is it then? Because Starlink seems to have the consumer market pretty much locked down right now.
It's about connecting the industrial dead zones of the world directly to the AWS cloud.
Yeah.
You know, think about something called data gravity.
Data gravity. Okay.
Imagine an oil rig in the middle of the ocean, or a massive mine in the Australian desert, or a fully automated farm in the middle of Nebraska. These places generate enormous amounts of data from their sensors and machines. Currently, getting that data from the remote location to the cloud is really hard and slow.
Right. The cell service and internet connectivity sucks in the middle of the ocean.
Exactly. Amazon wants to use its Kuiper satellites to beam that data directly from the oil rig or the mine into an AWS data center. They want to provide the connectivity and the cloud processing in one seamless integrated package.
Ah, so you buy the satellite dish from Amazon, it connects to the Amazon satellite, which then beams your data straight into an AWS data center in Virginia. You completely bypass the public internet.
You bypass it entirely. It creates a new vertical. And they just recently signed a partnership with AT&T to help cover mobile dead zones for regular cell phones.
Yeah.
This is an infrastructure play that Google and Microsoft simply do not have. They have the cloud, but they don't have that global connectivity layer. Amazon wants to own the pipe and the destination.
It's incredibly ambitious and incredibly expensive.
Very. It's another layer of this global utility thesis.
Yeah.
They want to be the electricity, the water, and now the skyway.
Which brings us right back to the money, that $200 billion. Where does it actually go? I mean, it doesn't just evaporate. It flows somewhere in the economy.
It's a massive wealth transfer. It's a fire hose of cash. Amazon is essentially taking money from its bank account and handing it directly to the entire hardware ecosystem. So if you're an investor, you don't just look at Amazon. You look at who Amazon is paying. You follow the money.
So who gets rich from Amazon's spending spree? Who are the beneficiaries?
Well, obviously the big construction companies building the physical data centers.
Yeah.
But look deeper at the suppliers. A company like Marvell Technology. The ticker is MRVL. They are a chip design company that helps Amazon manufacture the custom Trainium chips. If Amazon is making 500,000 of these chips, Marvell is having a very, very good year.
Okay, so Marvell for the chips. Who else?
Fabrinate. Ticker is FN. They make optical interconnects. These are the super high-speed fiber optic cables that let all the chips talk to each other inside the data center. You can't have an AI supercomputer without massive amounts of this optical cabling. Amazon is buying literally miles and miles of this stuff.
And what about raw materials? We talked about digging holes in the ground.
Copper. At the end of the day, you need tons and tons of copper for power transmission, for cooling systems, even for the circuit boards themselves. Amazon has signed partnerships with mining giants like Rio Tinto just to secure a stable supply of the physical copper needed for this massive build-out.
It's wild to think about that. A software revolution in AI requires digging more holes in the ground for copper. It's so 19th century.
That's the physical reality of AI.
Yeah.
It isn't just code floating in the ether. It's heavy industry. It's gigawatts of power and tons of metal. And that's why this all-in signal from Amazon is so powerful. There is one metric that really highlights just how aggressive they are being compared to their peers.
Okay, what's the metric?
It's the reinvestment rate. Amazon is currently reinvesting nearly 90% of its operating cash flow back into capital expenditures.
90%. So for every dollar they make from running the business, they are putting 90 cents right back into building new stuff.
Yes. Now, compare that to their rivals. Microsoft and Google are reinvesting somewhere between 40% and 60%.
Yeah.
They're holding a lot back. They're saving some for dividends, some for share buybacks.
Whoa. That is a stark, stark difference.
It tells you everything you need to know about their mindset. Microsoft and Google are trying to balance growth with returning cash to shareholders. They're trying to be polite, to keep everyone happy. Amazon is saying, no, we are betting the entire retail empire's profits on winning the AI infrastructure race. We are not saving for a rainy day. We are building the weather machine.
It's incredibly bold and also kind of terrifying.
It is. And that's exactly why the stock dropped. Wall Street likes predictability. A 90% reinvestment rate is not predictable. It's a wartime footing.
So let's get to the verdict here. We've laid out all the pieces, the massive spending, the custom chips, the agentic AI revolution, the negative cash flow. If I'm a listener sitting here thinking about my portfolio or just trying to understand the future of tech, what's the call? Let's start with the bear case. Why should I be genuinely worried about this strategy?
The bear case is actually pretty simple. They are burning way too much cash. Negative free cash flow in a high interest rate environment is a dangerous game. If this agentic AI revolution is delayed, if it really takes off in 2028 instead of 2026, then Amazon is stuck with billions of dollars worth of empty, expensive data centers. That is the field of dreams nightmare scenario.
And there is still the Google threat, right?
Absolutely. The second part of the bear case is that if Google's technology just turns out to be better, if their Gemini model is fundamentally smarter or more capable than the models running on AWS, then no amount of spending on infrastructure will save them. Developers and businesses will ultimately go where the best intelligence is.
Okay, that's the bear case. It's compelling. Now give me the Griffonomics verdict. The bull case. Why is this a smart bet?
The bull case is what we're calling risk-defined, portfolio protected.
Unpack that for me. What does that mean?
Look at the valuation first. Because of this panic over spending, Amazon's stock is now trading at around 23 times forward earnings. That is actually cheaper than Google. It's significantly cheaper than Microsoft. You are getting the opportunity to buy the market leader at a discount, precisely because everyone else is afraid of the short-term CapEx bill.
So it's actually a value play in a weird way.
It's a value play on long-term growth. And the moat here is real. The combination of their proprietary silicon Trainium and their massive scale means that Amazon can, eventually, offer lower costs for AI compute than anyone else. If you are an AI startup and your single biggest line item is your compute bill, are you going to pay the Nvidia tax at Microsoft, or are you going to use Trainium at AWS for 40% less?
Economics always wins in the end.
Exactly. Amazon is betting that AI will eventually become a commodity utility, just like electricity. And in any utility market, the lowest cost provider wins. That is Amazon's DNA. They did it with books, they did it with the cloud, and now they are trying to do it with intelligence itself.
And the big Wall Street analysts seem to agree, right? Despite the initial shock, firms like Morgan Stanley, Bank of America, they all kept their buy ratings on the stock.
They do. They view this dip as a golden opportunity. They see the negative cash flow as temporary pain for enormous long-term gain. They believe Andy Jassy when he says they are monetizing this new capacity as fast as they can build it.
So the final conclusion is, Amazon is willing to trade short-term financial optics, basically looking ugly on a Wall Street spreadsheet for a year or two, for a complete and total long-term infrastructure dominance. They don't just want to be in the AI economy, they want to own the rails it runs on.
Precisely. They're building the railroad. Everyone else is trying to build the fanciest train car. Amazon just wants to own all the tracks.
Right.
And if you own the tracks, you get paid no matter whose train is running.
I love that analogy. Okay, we have covered a ton of ground today. We unpacked that massive $200 billion bet. We looked at the technical shift to agentic AI that moved from simple chatbots to autonomous digital workers. We analyzed the brilliant chip strategy with Trainium and the ambitious satellite play with Kuiper. And we faced the scary reality of negative free cash flow.
It's a very complex picture, but the strategic direction is crystal clear.
It is. And before we sign off, I just want to leave the listener with one final provocative thought. We sort of touched on this briefly, but I want to push it a little bit further.
Go for it.
If Amazon successfully automates 75% of its retail operations, so you have robots moving all the boxes, AI managing all the ads, AI agents writing the code, and they move their entire AI infrastructure onto their own custom-designed ships, are they even a retailer anymore?
That is the big question, isn't it?
Or are they fundamentally becoming a global utility company? Like an electric company, but for commerce and intelligence. And if 2026 really is the year of the AI agent, as they believe, what happens to all the companies that didn't spend $200 billion to prepare for it?
I think we're going to find out very quickly that there are only two types of companies in the future. Those that built the AI infrastructure and those that have to pay rent to the ones that did.
Rent seekers of the AI age. That is a chilling thought. Keep your eyes on that Trainium versus Nvidia battle, folks. That is the real scorecard to watch. Thanks for diving deep with us today.
Always a pleasure.
See you next time.